Welcome to the Pro Ticker Deep Dive. Today, we're really digging into something pretty remarkable. Our sources lay out this incredibly bold year-end prediction for the S&P 500. It's coming from Tom Lee over at Fundstrat Global Advisors.
Yeah, and it's quite the call. He's looking for the S&P to hit 7,500.
7,500 before the end of December 2025.
Exactly. And, we're doing this deep dive right now because the market's at such a fascinating spot. I mean, the S&P 500 has had a fantastic year already.
Oh, absolutely. It's up over, 16% so far in 2025? Trading very close to that all-time high we saw recently, around 6,920.
Right near there. So context is key. The index is currently sitting around, let's say, 6,772.
Okay.
Getting to Lee's 7,500 target. Well, that means another 11% jump.
In just 2 months, from already elevated levels, that feels incredibly ambitious.
It is ambitious, and that's the core tension here, isn't it? Lee's optimism, it's built on some specific, pretty powerful technical and behavioral catalysts he thinks are lining up perfectly.
Like a perfect storm brewing for the bulls.
Sort of. But on the other side, you've got some serious headwinds. You've got historical valuation measures like the AIP ratio, screaming danger, flashing red lights. And it's not just theory. You've got very senior Wall Street CEOs, people like Ted Pick at Morgan Stanley, David Solomon at Goldman, publicly voicing caution. So it's momentum versus gravity, really.
Okay, so let's unpack that. We should start with the bull case, with Tom Lee himself. He's got a reputation, right? Known for being one of the most optimistic guys on the street, but often surprisingly accurate.
He does. He's definitely earned that reputation, a consistent bull. And interestingly, his argument right now starts from a place you might not expect. It starts with how pessimistic everyone else is.
Right, this famous wall of worry. I saw the stat in our research. Despite the market being up 16% this year, average investor sentiment was negative, like minus 11.5.
Minus 11.5 on average for the year. It's quite something.
That just sounds wrong. I mean, minus 11.5 is the kind of fear you expect in a crash, a deep bear market, not when your stocks are hitting record highs. Why is everyone so down?
Well, there's lingering recession fear, maybe some inflation anxiety still, a lot of skepticism. But Lee looks at that and sees something totally different. He sees it as incredibly bullish.
How so? How is pessimism good?
Because, historically speaking, bull markets don't usually peak until pretty much everyone is optimistic, fully bought in, when there's still this much negativity, this much doubt, even as prices climb.
It means there are still people on the sidelines, skeptics who haven't bought yet.
Exactly. There's fuel left in the tank, a huge pool of potential buyers who could still come into the market. It's like a buffer against the kind of universal euphoria that usually marks a top.
Okay, I see the logic there. The pessimism provides a sort of psychological floor. So if that's the backdrop, what actually makes the market jump 11%? What are the mechanics?
So Lee breaks it down into three main pillars. They sort of feed off each other, especially in these last 8 weeks or so of the year.
Okay, what are they?
First, there's what he calls the performance chase. That's the behavioral part. Second is cash rotation, where the money actually comes from. And third, you've got favorable seasonality and some key macro factors like inflation and, interestingly, AI productivity.
Got it. Let's tackle pillar one then, the performance chase. This sounds like it's about professional investors feeling the heat.
Absolutely. The numbers here are pretty stark. Our sources show that over 80% of active fund managers, 80%, are lagging behind their benchmarks this year.
Wow, 80%. That's not just having a slightly off year. That's potentially career-threatening territory for these managers, isn't it?
It's huge pressure. Think about it. You're managing billions, maybe. You're trailing the S&P by double digits heading into year-end reviews. Clients are looking at their statements.
They're asking tough questions. Your bonus is on the line, maybe even your job or your whole fund.
Precisely. So Lee argues these managers are forced to chase performance. They have to increase their exposure to stocks, especially the winners, just to try and catch up. It's not about conviction anymore. It's about survival.
So it becomes this self-feeding cycle. Lagging managers buy, pushing prices up.
Which forces the next group of underperformers to throw in the towel and buy too, probably at even higher prices.
Yeah.
It's buying driven by career risk, pure and simple. Real money flowing because of that pressure.
And there's some history to back this up, like when the market's already had a strong run into November.
Yeah, there is. The data shows that when the S&P 500 is already up more than 15% by the start of November, historically it tends to add another 2.7% on average through December.
So that late year push aligns with this idea of managers scrambling to catch up.
It fits perfectly, and that chase needs fuel, right? Which brings us neatly to pillar two, the money itself. The $7 trillion cash elephant, as it's sometimes called.
Right, this huge number, $7 trillion supposedly sitting in money market funds on the sidelines. But okay, let me push back a bit here. Is all that cash really waiting to jump into stocks? Isn't a lot of that just, corporate operating cash or institutional money that needs to stay safe?
That's a fair challenge. And you're right, not every dollar of that $7 trillion is poised to flood into tech stocks tomorrow. But think about why so much cash piled up there in the first place.
High interest rates, right. You were getting paid over 5% risk-free. Hard to argue with.
Exactly. Cash was attractive. But now, the Fed has started cutting rates. The Fed funds rate is down closer to, 3.75% to 4%? Suddenly, getting just under 4% on your cash looks a lot less appealing compared to potential equity gains.
So the relative attraction is shifting. The opportunity cost of not being in stocks is going up.
Precisely. And the scale here is just immense. Lee's point is you don't need all $7 trillion to move. If just a small fraction, say 5% of that pool, and remember this includes retail money, wealthy individuals, corporate treasuries looking for yield, if just 5% rotates into equities.
5% of $7 trillion is $350 billion.
$350 billion. Now compare that to the average daily trading volume in the S&P 500, which is maybe $400 or $500 billion.
Wow, okay. So $350 billion flowing in over a few weeks could easily overwhelm daily trading and push the market significantly higher.
That's the argument. The potential buying power available is just huge relative to normal market liquidity. It can fuel a serious rally if even a bit of it gets deployed.
That really puts the potential impact into perspective. Okay, let's move on to Pillar 3, the macro drivers. Lynn has some interesting, maybe even contrarian views here, especially on inflation.
He does. He argues that the real inflation picture is actually improving more rapidly than the official headline CPI numbers might suggest right now.
How's that?
His focus is on shelter costs, rents, owner's equivalent rent, that sort of thing. It's a massive chunk of the CPI basket, maybe a third or so. And Lee's data suggests shelter has finally cracked. He's seeing rent inflation slow down significantly, like to 3.8% year over year.
Which is the lowest since when? Late 2021.
That's right. And why that matters is because if this big, sticky component of inflation is finally easing off, it gives the Federal Reserve a lot more justification, a lot more room to continue cutting interest rates.
And lower rates are generally good for stock valuations, especially growth stocks.
Universally supportive, yes. Lower discount rates boost present values. Then there's this other weird factor, the recent government shutdown mess.
Yeah, the statistical blackout, no official CPI, no jobs reports, no GDP data for a while. Usually uncertainty like that makes markets nervous, right?
Typically, yes. But Lee actually spins this as a short-term positive.
No.
His take is kind of interesting. He thinks removing those high-impact, potentially volatile government data releases actually removes sources of negative surprise for the market in the short term.
So no bad news is good news, essentially. It lets the positive momentum continue without being derailed by a shock jobs number or something.
That seems to be the idea. The market digests information constantly from other sources anyway, he suggests, so removing the official headline noise just helps stabilize things while the chase and rotation dynamics play out. Fewer potential panic triggers.
Okay. And the final piece of this pillar is AI, artificial intelligence driving profits.
Yes, the AI productivity story. This is crucial for justifying higher valuations. Lee's quite bullish here, arguing that AI is letting companies boost efficiency so much that they can expand profit margins even if their revenue growth slows down.
He made a really specific claim, didn't he? Something about companies being able to absorb like 70% of new tariff costs because AI is making them so much more productive.
He did. It's a bold claim, suggesting massive immediate productivity gains that flow straight to the bottom line. This is the narrative that helps investors feel comfortable paying high prices for stocks, especially tech stocks.
Is it actually happening? I mean, we hear a lot about AI, but is it really boosting profits across the board yet?
And that's the critical counterpoint, the skepticism. The sources we looked at also highlighted things like the McKinsey research.
Right, the one that said something like almost 80% of businesses trying generative AI
reported no significant impact on the bottom line so far.
Okay, so that's a major disconnect. We have this hope, this market narrative, pricing in huge AI gains, but the on-the-ground reality reported by many businesses is not yet.
Exactly. And that disconnect, that gap between the promised future and the current reality, leads us directly into the bear case. Because if those AI profits don't show up soon or aren't as big as hoped,
then these current market valuations look really, really stretched.
Precisely. Which brings us to the big flashing warning sign, the SAPE ratio. the cyclically adjusted price-to-earnings ratio.
Yeah, Robert Shiller's metric. It smooths out earnings over 10 years, right?
Yeah.
Gives a longer-term view of valuation, less noisy than just looking at 1 year's PE. And where is it now?
Our sources clocked it hitting 39.5 in October.
39.5. Okay. Put that number in context for us. How high is that historically?
It's extraordinarily high. That level, 39.5, has basically only been seen once before in modern market history.
Let me guess. The dot-com bubble.
1999, 2000.
Yeah.
Right at the absolute peak. And we all know what happened next.
A massive crash. The market lost, what, over 40%? Took years to recover.
It was brutal. So seeing this APE ratio back at that same peak level, it's a profound warning sign. It suggests the market is baking in assumptions about future profit growth that are just heroic, maybe even unprecedented outside of that internet bubble moment.
It really is a reality check. And it's not just an academic metric flagging this, is it? You mentioned CEOs earlier.
Right. Very prominent voices, Ted Pick at Morgan Stanley, David Solomon at Goldman Sachs, both have come out recently with public warnings. They're talking about the potential for a significant market pullback, maybe 10%, even 15%.
And they're pointing specifically at what? Valuations.
Primarily stretched valuations, especially in technology, and the risks that come when market leadership is so narrow and sentiment is so high. When guys running two of the biggest shops on the street are saying, watch out, you should probably listen.
Definitely adds weight to the caution. What about the technical picture? Where are the key levels traders are watching?
Well, the immediate hurdle is just overhead. That recent all-time high zone, roughly 6,850 up to 6,900. The market needs to decisively break through there to keep the bullish momentum going strong.
And on the downside, where's the danger zone?
The really crucial support level everyone's watching is around 6,625. That was the low point we bounced off back in October. If the market breaks below that level convincingly,
That could trigger more selling.
that's the fear. Breaking 6,625 would likely open the door to a deeper correction, potentially down towards the 6,400 area. And that's where you get that 10-15% drawdown the CEOs were warning about. It becomes a much more real possibility.
Okay, so we have the KP warning, CEO warnings, key technical levels. What other major risks could knock Lee's 7,500 forecast completely off course?
Our sources flagged a few key ones. First, job growth has definitely been slowing down. If that continues, it eventually hits consumer spending, which is the bedrock of the U.S. economy.
Makes sense.
Second, there's still some uncertainty around tariffs, especially with the Supreme Court ruling pending on some of them. That could be a curveball.
Okay.
And third, you can't ignore the global picture. Growth in places like Europe has been weakening. A broader global slowdown would eventually create headwinds for U.S. companies, too.
Right. It's all interconnected. Okay, so let's try and synthesize this. We've got Tom Lee's powerful bull case, driven by this performance chase and cash rotation, aiming for 7,500. But we've also got these extreme historical valuations, CEO warnings, technical risks, pointing towards a potential 10-15% drop. Where does that leave us? What's the most likely path forward in the next couple of months?
Look, hitting 7,500 requires, well, pretty much everything to go perfectly right for the bulls. The cash has to rotate smoothly, no major geopolitical shocks, the manager panic has to sustain itself. It's a high bar.
Seems like a stretch goal, maybe.
It does feel like a stretch. However, the forces pushing the market higher into year-ends are real.
Yeah.
That performance chase is powerful. Seasonality is typically favorable. The liquidity from cash potentially shifting, it's significant.
So maybe not 7,500, but still strong finish. Perhaps something like the 7,200 to 7,300 range feels more plausible. It respects the bullish forces without needing absolute perfection.
I think that's a more probable scenario, yes. A strong rally into year-end, pushing into that 7,200, maybe 7,300 zone, that would still represent a very solid gain from here, driven by those behavioral and liquidity factors.
Okay. But for you, the listener, what's the key takeaway here? Even if we rally, the risks haven't vanished.
Absolutely not. The final caution is critical. This market, by historical standards, is expensive, very expensive. That 10-15% correction scenario, it is absolutely still on the table, especially from these levels.
So risk management is crucial.
Paramount. Don't get carried away by a potential melt-up. Avoid excessive concentration in just a few hot stocks. Be wary of using leverage. And most importantly, know your exit points. Set your stops. Protect your capital in case that historical gravity suddenly takes hold.
Wise advice. And that brings us to our final thought for you to ponder. We've talked about this extremely high TAPE ratio, 39.5, a level only seen before the dot-com bust. And we've talked about the uncertainty around AI productivity of the big hopes versus the current lack of widespread bottom line impact.
So the question really becomes, can the future, maybe still distant productivity gains promised by AI, truly justify a valuation metric like a 39.5 CPB show today, right now?
Or is the market already pricing years, maybe even a decade, worth of AI-driven profit growth that hasn't actually materialized
And
yet?
if it's the latter, if the market's gotten way ahead of itself based on that AI promise, could we be setting ourselves up for the kind of scenario Robert Shiller himself warns about? A potential lost decade where returns are flat or negative as reality catches up to valuations.
Something definitely worth thinking about as we navigate these final weeks of the year. A really fascinating setup. See you all in the next Pro Ticker Deep Dive.